Good morning, this is Jorge Herrera and today's Tuesday and I'm here with you to share again my passion on the infinite banking concept. After so many of these videos, I just hope that some people find the value that is offered by the infinite banking concept. The infinite banking concept is a platform, or it uses an insurance platform and banking strategies. It was created by Nelson Nash back in the I would say maybe in the 1980s, and he wrote the book Becoming Your Own Banker in the year 2000, and this allowed us, his students, to be able to promote and help him grow his cause of helping families secede from the um, economic regime in which we are bound, so secede one family at a time. And this is what we're trying to do, to help change the economic environment, because definitely is not good for the average family. So why should you keep your money with the insurance industry instead of keeping it with the banking industry? Many reasons. Prior to like the 1960s, many families had their money, their savings in insurance companies with whole life policies. And the banks worked very hard, and then came the popularity of Wall Street, which the banks are a big part of it, and they were able to switch the mentality of the people and allow them to take control of the financing factor in our lives. Because nowadays, the majority of the population only have one option to finance, and is go. And it is to go to the friendly bankster. And normally the friendly bankster does not take decisions based on your benefit. They take decisions based on their benefit. So let's look at let's look at some of those differences. Now, this graphic that you see here is because when the infinite banking concept was being promoted in the early 2000s, many people associated it with investing. And the infinite banking concept is not an investment. It is a lifestyle. It is a money depository. So it's not an investment. Now, it does have the features of a great investment, but it's not an investment. So if you compare having money on a solution created based on the infinite banking concept, I mean an insurance, a dividend paying whole life insurance contract with a mutual company, it is not an investment. So that I wanted to mention that because this graphic was created to show the features of the solution created according to the infinite banking concept, which it has many features of a great investment. But we're going to compare it with a bank. That's the actual comparison that can be made, because you cannot compare an infinite banking concept policy with mutual funds or stocks or real estate, because it's not the same. They are very different animals. It has some similarities with some of them, but they are not the same. With the bank is where most of the similarities are, because in a bank you can deposit money, you can earn interest, which is nothing, you can pay interest, which can be a lot, and you can borrow money. So when you do that, we can compare that with an insurance policy, because in an insurance policy, you deposit money, you pay interest to the insurance company. That didn't exist prior to 1986, where the IRS made a change. And you can borrow money from an insurance company, and you can also earn interest, which is guaranteed by the insurance company. Plus, you earn dividends. Those are not guaranteed, but they've been paid basically in the history of these companies, and that's why we select mutual companies to do this. Because when we select mutual companies and we obtain policies with the mutual companies, we actually become part owners of the companies. That's one of the many benefits. So let's talk about liquidity. Yes, in the bank you have liquidity based on the savings that you have in the bank. And that's why it is compared to an insurance company, because you also have liquidity in the insurance company. Now, it can happen, and you are not obligated to answer, but in a bank, let's say that you have $100,000 in savings, and then you go and you say, hey, I want $75,000 of my savings. You are not obligated to answer, but they probably might ask you, what are you going to do with the money? It's none of their business, but they are used to, because they own the money that you are requesting to take those $75,000 that the bank has to allow you to take it, because they sign an IOU when you deposit it. But with the insurance company, you just fill up a one-page request and send it to the insurance company, and they mail you the check, or they transfer you the check, no questions asked. Now, if you request less than $25,000, then that can be done on a phone call. You don't have to fill no forms. So yes, there is liquidity on both the bank and your insurance company. What about efficient or high rate of return? Well, there's a big difference there. Banks used to pay, but since they became so critical and so much the speculation is that their business, even though they they make tremendous earnings, I don't know, they just decided that they didn't want to pay any interest. And in Japan and Europe, there are some banks where they actually charge people to keep their savings with them. It's crazy. So with the insurance company, we get a guaranteed interest that depending with the insurance company that you're using, it could be a guaranteed 2% or 3 or 4%, and plus the dividends. The dividends are not guaranteed, but they've been paid in the history of these companies. Tax-free growth. There's no tax-free growth in the bank, but there is tax-deferred growth in the policy, and but you have tax-free use when you take it as a loan in the insurance with the insurance company. Market volatility. Well, there's no market volatility in the bank either, but who cares if you don't get any returns? Now, there's no market volatility in the insurance industry either, even though you're getting a high rate of return. Safe. The bank, because the fact that they use fractional reserve lending is a critical operation, so they are really not safe. And yes, they are protected by the Federal Deposit Insurance Corporation, but that's a joke, because the capital on the Federal Deposit Insurance Corporation is like $80 billion or $100 billion, but the deposits in the United States could amount to $10 trillion. So what can $80 billion can do to secure $10 trillion? Nothing. So in the insurance industry, your money is safe. You could feel good that 10 years from now, if you do your part, if you pay your premiums, your money is going to be there. Control. You could say that you have control of your savings account or checking account, but why is it that you get a letter from the bank from time to time where they say, beginning such a date, let's say beginning June 15 or July 1st, the interest on your saving account is going to be now this much, or the interest that you're going to have to pay if you're using your credit card that we provide for you, the interest is going to be this much, and you're going to have to pay certain penalties if you don't pay within certain days. All that is stated on a letter that the bank sends to you on your account. So whose account really is the bank's account. So you don't get that with your insurance company. Now, guaranteed. The bank, they say that they're going to pay you certain interest on your savings, but if there is a crisis and they go critical to go out of business, they really won't pay you. So there's no such a guaranteed. With the insurance company, there is a guaranteed that because of the reserves that insurance companies keep, you're going to get what they say you're going to get. On top of that, there is reinsurance that among the insurance companies, they insure themselves. So yes, you're going to get what they say you're going to get. Creditor protected. If you have an accident and you hurt somebody, this person can sue you, and then your money in the bank is at stake. Your money in the bank can be part of that suing business. Suing that this person gets you into. But if you have your money in the insurance industry, most probably it won't be touched because it's normally categorized as your retirement money. So it has basically the same protection that a 401k in that sense. No fees or penalties. With the bank, you get fees and penalties all the time. Just move money and you get fees and penalty. Or just stop putting money in the account and you get penalized because they force you to keep you a minimum. Now, in the insurance industry, if you take all your money out and you don't put more money, yes, things will happen. The policy probably would collapse, and then now you have to pay taxes. But if you just keep your premiums as you agree when you open your policy, then nothing will happen. No fees or penalties. Easy to manage. Well, both are easy to manage. Your money in the bank is easy to manage. Your money in your insurance company is easy to manage. Remember that I made this graphic to compare with investments. And some investments, you gotta go to school to manage those investments. Private. In the bank, your money is not private. That's why it can be touched if somebody sues you. It can be taxed if the IRS finds that you have too much money in there. And that too much money, I believe, is more than $600. And financial institutions see how much money you have in your bank. So if you are trying to get a loan or trying to get a grant or something from financial institutions, that could be an issue. In the insurance industry, your money is private. They don't see that. Transferable. Well, you can transfer your money in the bank, yeah. You can take the money out of there and pay somebody or give it to somebody. The same with the insurance industry, with the difference that it is an asset and you can sell it. Normally, you cannot sell a saving account in a bank. No, I don't think somebody else can buy your saving account and keep saving on it on your name. They just open their own saving account with the money that you pay them or transfer to them. Unreputable. Insurance companies have been in business for more than 100 years, and they have done pretty good when we have had money crisis. Not the same with the bank. With banks, because banks, they operate in a speculation, so their model of business is very critical, and they can go out of business when we have economic crisis. Because of the model of business, there are fractional reserve lending or fractional reserve banking, which is critical. So that can create bank runs, and that puts banks out of business. That doesn't happen with insurance companies, because insurance companies have 100% reserves requested by the states in which the insurance companies operate, and sometimes they have 110% reserve because the same insurance companies request it or decide to. So those are the difference between keeping your money in the bank and keeping your money with the insurance companies, especially if you set up that solution, a specially designed whole life insurance contract that receives dividends from mutual companies. And that's how we design these policies, or that's how we select those companies with the infinite banking concept. And we also design these policies for the growth of money. So it's a special design. So if you want to have one of these solutions, contact me. You can reach me at jorgeherrera.com or bankwithyoursavings.com. And just contact me and I'll help you set up one of these solutions. So thank you, and I'll see you next time.